Amazing. Welcome to the Forex class, the Forex Academy. This is the voice of the simple trading professor, and in this class, I'm going to be taking you through Forex. The previous training, I took you through the summary of Forex, introduction and summary of Forex. Okay, so I just summarize what Forex is all about. But right now, what I want to do is I want to dive into the main introduction to Forex. Okay, this training is for beginners and also for existing traders. If you have been trading before, this is for you. You are going to benefit from this training. For beginners, what you will learn from this training will help you to understand the financial markets. Okay, why if you're that person that you have been trading forex before, this training is also for you. Why? Because you are going to learn a lot from this training. Let me tell you some of the benefits you're going to gain from this training. Number one, for those who have been trading before, while you were trading, you pick up some many bad habits. Okay, this training will help to correct those bad habits that you have gained. Okay, some traders, they were self-taught, they taught themselves how to trade forex. By going through this training, you are going to realize that you know far less than you thought. Okay, and some traders, they came into the forex industry by signal services. They saw signal service, they decide to join signal service. They saw robots trading, they decide to join. And while they were doing this copy trading, they discovered that there is money in the financial market and they want to do this by themselves. By doing such, they lack the solid foundation, and this training will give you that solid foundation. A quick disclaimer, I want you to know that the financial markets carry some amount of risk. Yes, you can still make money from the financial markets. The financial market is over $7 trillion industry. You can make so much money to live the life you want to live, but also realize that there are also potential losses in the market. Okay, so let's dive into the class. The first part is the introduction to forex trading. What is the financial market? We're going to help you to understand what the financial market is, and also we're going to help you understand the main components that are being traded in the financial markets. Once again, my name is Peace Ejiro. I'm a trader, I'm a trainer, and I've been in this space since 2017. Okay, I've been teaching and coaching people forex since 2019, and I've coached hundreds and thousands of people how to trade the financial market. I have been involved in organizing financial growth seminars since 2016, and I have been keynote speakers at various financial conferences. You can call me the simple trading professor. Now, in this training, there's something we want to do. Yes, I know this is how to trade forex. You have come here to learn how to trade forex, but your goal is to make money, regardless of that we are here to learn. The major goal is to make money. I believe that is your goal. And in this training, I'm going to be teaching you what the forex market is, how the forex market work, who are the major players, how big the industry is. We're going to see what are the risks involved. How can you walk around the risk? What are the pitfalls in forex? How can you avoid those pitfalls? How do you trade safely? Understanding your trade. How do you manage your trade? What strategy can you use to pick up a trade? And then we're going to show you how to open a demo account where you can practice, and then how to open a live account, put money, and make profits. Okay, so once again, I want to welcome you to the session. Okay, so you're hearing the word for the first time, forex. What does it mean? You can see the spelling. For those of you who cannot spell forex, the spelling is Forex. Okay, that is forex. So what does it mean? Simply, you can see the picture above this audio. You can see that forex means it is like an acronym. Okay, they took FOR from the word foreign, and they took EX from the word exchange, put them together, made up what? Foreign exchange. So what is this foreign exchange we're talking about? Yes, the foreign exchange or the forex market is a process in which a nation's currency is traded for another nation's currency at a mutually agreed rate. The financial market is way about $7 trillion as we speak right now. Okay, it is the largest market in the world. It is larger than the futures markets, larger than the New York Exchange market, larger than the equity markets. Okay, and each day, multinationals, banks, investment firm, hedge funds, corporations, and retail traders like you and I, they call us retail trader. Okay, and we are not the major guys here. Okay, we are just here to take advantage of the big price movements that is happening in the market to make profits. Okay, we all know that the forex market has grown in popularity recently. Okay, a lot of people are not trading forex. Over 10 million retail traders. You and I put together, we are all 10 million together that are trading the financial market. Why? Because we want to make money from this $7 trillion market. We want to have a share from this market every single day. That is why we are trading. So the question is, what can you trade on Forex? Now, looking at what we can trade in the financial markets, we have the Forex markets, which involve currency pairs. Okay, currency pairs, the currency of one country against another country. And in these currency pairs, we have what we call the major currency pairs. We have the crosses and we have the minors. Okay, we also have commodities which can be traded in the financial markets. Commodities can be traded. Commodities like gold, silver, okay, oil. These are commodities that can be traded. Okay. We also have indices that can be traded. Okay, which is indices means the major economies in the world. Okay, such like Dow, DAX in Germany, and FTSE in UK. Okay, so you may not understand if you are so new to forex, but later you get to understand all of this. So we also trade stock. What is stock? Stock are major worldwide companies. Okay, they form part of the indices of a certain country. Okay, so this thing I just said right now, what is being traded? See, I know I just spoke like a big grammar, but don't worry about this. To make this simple for you, see, what is being traded in the financial market, just know that it is different currencies of the world. Okay, in the forex market, you will see it as pairs, two currency tagged together, which is euro and dollar. They tag them together. Okay, you can see USD and the Japanese currency. Okay, they are tagged together. You can trade them. Okay, we want to talk about commodity. Gold, you see it as XAU paired with the dollar. XAU paired with the dollar. Okay, you can also see other stock like you can see Facebook is a company. You can trade Facebook. Okay, you can trade Google. These are stock. Okay. Okay, talking about currency pair, this is how you see a currency pair in the financial market. For example, you see Euro, USD. They are always tied together. The first one you see is called the base currency. The second one is called the what? The quote currency. Okay, now what does this mean? Euro, USD. It means, or it's showing you how many US dollar do you need to buy euro? You get the point now. How many US dollar do you need to buy euro? Okay, so the first currency is the base currency, and the second one is the what? Is the quote currency. This is how you're going to be seeing it in the forex markets. Now, I told you about the currency pair. We have the major currency pair, the minor currency pair, and the exotic currency pair. Okay, now let's talk about the major currency pair. When we talk about major, what does it mean? It means the most actively and commonly traded pair in the forex market. These are the most actively traded pair. We have the Euro USD, the GBP USD, the USD JPY, the USD CHF. Now, these are the most commonly traded. These are the most actively. The most commonly traded are the NZD US dollar, the AUD US dollar, and the US dollar Canadian dollar. Now, what you must see or notice about this pair is that each of them are connected to the dollars. Okay, and the dollar accounts for roughly 90% of all the currency transaction. See this? These are the major currency pairs. Okay, these are the minors, and these are the exotic currency pairs. The major currency pairs drive the market. So as a beginner, you want to focus on the major currency pair. Why? Because the major currency pair are the most traded currency pair. Okay, they form 90% of the daily forex volume. So you want to focus on the major currency pair as a beginner. This will help you make much more profit in the market as a beginner. Now, one reason why I love Forex is this. With Forex, you don't need a boss. You don't need to have a boss. You are your own boss. Okay? You work from anywhere in the world. You don't need an office place. Okay? You can work on the go with your phone, just your phone. Okay? If you have an office space in your house, like me, my house is my office. Okay? I have an office space in my house where I do business from. That is where I work from. Okay, and you can work from anywhere. You can travel around the world while you're trading forex and making money. Okay, it is so flexible. The market is open 245. Okay. Now, one reason why I love forex is that forex is a 247 market. It's a 247 market. Okay, let's say 245. Okay, the market is open 24 hours a day, Monday to 5. The market is flexible, so you get to trade Monday to Friday. Okay, the market is open 24 hours and it has about 4 different sessions, and these 4 sessions are what? They are overlapping sessions. They overlap each other. Now, which are the sessions? We have the number one as the Sydney in Australia, the Sydney session, the Tokyo session, the London session, and the New York session. Okay, New York in United States and London in England, Tokyo in Japan. So these are the sessions. So the market is flexible. Any time of the day you can trade. From Monday to Friday, any time of the day, the market is open for you. Now, I want you to know that the vast majority of the currency forex trading happens in, or it is concentrated in these 4 major financial centers. We have the London, the New York, and Sydney and Tokyo. What this means is in London, 8 o'clock bank opens. UK, okay, New York, okay, this is New York, bank opened by 8 o'clock. So you see that when the bank opened by 8 o'clock here, it closes by 4 p.m. Okay, at this time in New York, bank open at this time, closes at this time. Sydney, bank open, this is 8 o'clock when bank open. So you see that because of different time zone, there is an overlapping. When the bank in New York opens, the London session is still on. So what do you see? Further, that there's a lot of trading volume going on here because 2 financial centers is open at the same time. We also have that happening here as well. So these are now who are the participants of the forex market. Yes, you are one of the participants of the forex market. We call you the retail traders. Aside you, we also have the central bank, the trade forex. We have different forex brokers who also trade forex. Commercial banks like the bank you know, okay, bank around you, First Bank, GT Bank, they trade forex. Okay, we have the exports, importers, tourists, investors, immigrants. These are the big guys that trade the forex market. Investment managers, hedge fund, multinationals, okay, brokers. Now you and I, we are called what? Retail traders. We are called retail traders. We also have investors. Okay, people who have large money that they want to trade. Okay, so these are the participants of the financial market. All of us put together, we are the ones trading the forex market. Okay, at this point, let us move over to the basics of the forex market. Now, like I told you in the previous sessions, I told you there are 2 different ways that you can trade forex. But our focus here is not on the sports forex. You know, sports forex is you going to the market or to the bank to buy the raw cash, raw dollar cash. That is sports forex. It means you are going to buy the cash, hold it, and put it in your pockets. That is not what we are doing here. What we are doing here is called CFDS. CFDS, contract for difference. That is what it means. CFDS, contract for difference. It means that instead of you buying and selling large amount of currency, what we are doing, we are only taking advantage of price movements, okay, without us having to own the real asset itself. Let me tell you something. You know, if a man, or let's say for example Ford Motors from let's say from US, they have dollars. They want to buy machine parts. They want to couple, let's say, about 1 million cars. Okay, now they want to buy machine parts and other parts. Now they go to China or Japan, for example, and then they flew to Japan, and then they want to use their dollar to what? To buy some machine parts from Japan. Now the question is, do you think they will be able to use their dollar from United States to buy these machine parts in Japan? It is not possible. So what do? They convert their what? Their currency from what? From dollar to yen, to Japanese yen. Now, what they are doing is that they are selling their dollar and buying the what? The yen. Remember economics. Whenever there's a demand for something, it increases the price. Why? Because if there's a reduced supply and there's a demand, the price will go up. Now imagine that Ford Motors is carrying trillions of dollars, billions of dollars to Japan. Imagine that they want to use that billions of dollars to buy Japanese yen. It means that they are buying large amount of Japanese yen. What do you think will happen to the price of Japanese yen? That is a demand for Japanese yen. And the price, see, that transaction alone is going to move the markets. Now, why that transaction is what is moving the market, and other big transactions like that is what is moving the market. Remember, we're talking about session, okay? So they have to wait for a bank to open for them to make that transaction. You get the point now. So that is where the forex session comes in, the financial centers comes in, okay? Now, when they are doing that transaction is moving the price of the Japanese yen. So why those big transactions are moving the price of the forex markets? You and I are involved in what is called CFDs, contract for difference. We are not taking advantage of those price movements. The price of Japanese yen, for example, is at let's say 100. Okay, 100, and we notice that Ford Motors want to go and make that kind of purchase. What do we know? We know that the price will shoot up. So we are going to come into the market as CFDs traders, and we are going to take a buy contract. We will take a buy contract. Now, our buy contract, we're going to say we are buying this contract that the market is going to go up. Now, when that transaction is done, what happened? The transaction pushes the price up because we took a buy contract that the price will go up. We are going to be on profits because finally the price will go up. I said, when we talk about CFDs, what we're talking about is we're talking about contracts, buying contracts. You are either going to buy a buy contract or a sell contract. Now, how is the forex market traded? This is how people trade forex markets, either by investment, speculation, or by hedging. Speculation means you are speculating that the price will either go up or go down. And by doing so, you are buying a forex contract, a buy contract or a sell contract, a CFDs contract. I want to talk about investment. How do people like you and I invest in forex? Okay, we call them more of a position traders. Somebody who is okay. I see that in the next 2 months, forex will the price of this particular currency pair will go up. Okay, it will go from 200 to 5,000. If the price is at 200, they foresee that the next 2 months, 6 months, the price will go from 200 to 5,000. They will just go there and place a buy trade with a small lot size. What I mean by small lot size is that their risk is very, very low, such that nothing will happen to that trade, even if there's a lot of fluctuation in the market during the first 1 month. So they will just place that trade and leave it. They will not be looking at the trade. They will go about doing other business. 1, 2, 3, 4 months later, they will check the trade. The price was at 200 when they entered the trade, but right now the price is at 5,000. Then they will close the trade on profit. You know, like I said, we are doing contract for difference. What is the difference between their entry and their exit? The entry was 200. The exit is 5,000. What is the difference? Contrast for difference. He took a buy contrast, a buy trade. The difference between 200 and 5,000 where he's exiting the trade is around 4,800. Okay, that is the profit. That is the profit. Now, what do I mean 4,800? Do I mean just $4,800? It could be $4,800. It could be above. Now, based on what we call leverage, we'll talk about that in the future. Leverage means that somebody that even have a $100 account can place that trade, and leverage, because of leverage, the money cannot be multiplied. Even if your entry, let's say you took a set trade, you analyze the market and see that the market will go down, okay, and then you took a set trade. As you took a set trade at the price is at 200 and you sell, why did you take a set trade first initially? Because you have seen that the market will fall down, the price of that asset you want to trade will fall down. So you took a set trade when the price was at 200. What is your expectation? That the price will get to what? To 150. Now, even if it takes about 6 months for the price to get from 200 to 150, you've banked profits. What's the profit? The profit is the difference between the entry and the exit. The entry is 200, the exit is 150. Contract for difference. The price went your favor. Okay? So you're banking about 50. Sometimes it may not be just $50 in 5 months. Because of the leverage, leverage now determines the amount of lot size you can use, the volume that you can enter the market with. That market cannot be, that profit 50 cannot be multiplied by 10, by 100. You get the point now. That is why somebody can be banking over making a profit of over from that movement, that from 200 to 150, somebody can make a profit of $5,000, $10,000, $50,000 in just that transaction, depending on the lot size. So that is how people can invest. Investment in Forex simply means you are entering the market right now. You don't want to look at the trade for the next 1, 2, 3, 4, 5 months. That is investment. When we talk about speculation, majorly, although investment is also like speculation, okay, investment is also like speculation as well. But when we talk about speculation, more of speculation involves you just come into the market, you speculate, okay, market will go up within the next 5 minutes, and then you place your buy trade. Market will go down within the next 2 days, you place your set trade. Or market will go down within the next 4 hours, you place your set trade. You understand? These are you speculating, but you don't just speculate anyhow. You speculate based on analysis, either fundamental analysis or technical analysis. The last one you saw there is edging. Okay, edging is you buying and selling at the same time. I do not expect any of you to go into to start doing edging. Edging is not for newbie. Okay, it's for advanced traders. Edging is for advanced traders, because you might imagine, why would somebody buy and sell at the same time? So it doesn't really make sense. Okay, some brokers, they won't tell you that if you edge, they will frown at you. So edging is not really for newbies. Okay, it's an advanced trading strategy. See, when I say contract for difference, okay, your entry point and your exit point. What is the difference between your entry and your exit? If you are selling your entry and your exit, what is the difference? We're going to talk more about that as we dive into this. Okay. Now, Forex is unique based on what we call position. Okay. This make Forex. If you don't get this correct, get it now. Okay, there are two type of position. Is either you are buying or you are selling. If market is going down, you sell from this point, and market come down, you go on profit. If market is going up, you buy at this point, and market goes up, you go on profit. If this is market, you went and buy here, market begins to go up, you are losing. Market must come down for you to sell. Okay, so you see that you can go long. When we talk about going long, long means buying. So this is long, you are buying. Go long means buy the market. Go short means sell the market. Sell means short. Short the market. Okay? Edging. When we talk about, you hear the word edging, it means you are buying and selling at the same time. You place a buy trade and place a sell trade in a particular currency pair at the same time. That is what it means. Yes, some people will now be asking, why do a currency pair increase in value? How do we know? See, this is what we call the economics of Forex. The economics of Forex. Okay, now the euro, for example, rises in value. Okay, when there's a demand, the euro USD, okay, as a pair increases in value when there is a demand for the base currency. When the base currency euro experience much demand and there's a reduced supply, it will increase in value. Now, Euro USD will decline in value when the demand is reduced. There's a fall in demand or supply rises. See, no matter what is there that increases the market, that plays a role, supply and demand is the major factor that will tell the price of a currency pair. Supply and demand. I said a buy trade means what? A buy trade is the same as a long trade. So, for example, if you have Euro USD and you want to buy this particular currency pair, what does it mean? It means that you are buying the euro. You are buying euro. You are selling the quote currency to buy the euro. That is what it means. Okay, this is the contract for difference. You are taking a buy trade at this point, long trade. You buy here, you expect it to go up for you to go on profits. If it's going down, you are losing. This is a buy contract. A buy contract will go up for you to be on profits. That is how it works. If a buy contract comes down, you are losing. At the end of the day, you're going to sell your contract. So either you sell on loss or you sell on profits. It's a buy contract. Now let's give you a good example. See, when you are buying a particular currency, you see this currency here, we are buying. This is a long trade. We are buying at this point. Okay, market is going up and down, up and down. When it gets to a low, we buy here. Why are we buying? We are buying with the expectation that price will increase. And we are going to close the contract. We're going to close the buy contract and make profit. So we buy here and close here. Okay, that is profit. So if we buy at 500, we want to close the trade when the price is around 700. That is when we can make profit because it has increased in value. So this is a short position, a short position. So when I say short, it means sell. Short USD/JPY, it means sell USD/JPY. So for example, if this is the Euro USD, we want to place a sell trade here, it means that it is the base currency we are selling. It is the base currency we are selling. We are selling the base currency, okay, and buying the quote currency. That is what it simply means. We are selling euro and buying US dollar. Are you seeing how it's playing out here? This is a sell contract, CFDS, a sell CFDS contract. Okay, we are taking the sell contract here. You know, when I say sell trade, for the sell trade to be on profit, the sell must go down. Why are you selling? You are selling because you have analyzed that the currency pair is going to decline in value. It's going to fall in value. The market is going to go down. So you take a sell trade. It's like you are betting. Will this football team win or they will lose? If you know that this football team will lose, what do? You place a bet that they will lose. Okay? In Forex, if you know that the market is going to fall down, it's like you are placing a bet that the market will go down. When that bet you are placing is called a sell bet. Okay, or a sell trade, a sell CFDS contract. If the market goes down, you're on profit. If it goes up, you lose. See how it's playing out here. You take a short trade or a sell trade based on one expectation. You expect the market to come down. Please understand this. Some people only know how to buy. They don't know. See, it's simple. There's a buy button and there's a sell button. Which do you click? If you feel like the market will go up, you click the buy button. If you do analysis and you feel like the market will go down, you click the sell button. So you sell somewhere around there, allow the price to come down. So you sell with the expectation that the price will decrease in value. From 1,000, the price will fall to 400, and you bank the profits. What is CFDS? CFDS means contract for difference. You sold the trade at 1,000, it fell down to 400. What's the difference between your entry and your exit? 1,000 minus 400 is 600. That's the profit. Okay, so we've learned how a short and long trade, a buy and sell trade look like. Now there's something called stop loss and take profit. Now this stop loss and take profit, we're going to learn much about it in the risk management part of this training. But then let us learn more about What is stop loss and what is take profit? Now, both of them are orders that you give to your broker, telling them when to close your trade. Okay, you give them a specific order, a specific instruction that close my trade for me, even if I am not with my phone at this particular time. So stop loss means you are telling them to close your trade for you on loss, while take profit means you are telling them to close your trade for you on profit, even if you are not with your phone, even if you are not looking at the markets. So that is what it means: stop loss and take profit. Again, stop loss is you telling the broker how much you are willing to risk on a particular trade. Why take profit is the exact of what stop loss is you telling the broker how much profit you are willing to take on a particular trade. That you are happy to close your trade at this amount of profit. You don't care what happens again in the market. Even if the market will give other people profit, much more profit, you are okay with that profit that you are currently having at that particular point. So you are going to set the level that if my profit gets to $100 profit, close the trade for me. Or if the price of the market gets to this amount, close the trade for me on profit. Whereas stop loss is you telling the broker that the market is going against me. Oh, I'm willing to risk this amount of money. If I lose $10, I don't want to take more than $10. Please close the trade on $10 loss. Okay, let's dive deep into take profit. Okay, so this is take profit order. So this is your entry point where you enter the market from. So you buy at this price, 1.10. That's when you buy. Now, when you took the buy trade, now you want to go about your normal business or your job that you are doing, or you are doing something else, you are flexing. So you want to say, okay, I bought at 1.10, okay, 700. Now, if the market gets to 1.11 300, I am okay with that profit I'm going to be getting. You know, this is a buy trade. Okay, so for you to be on profit, it's going to go up. So when the market gets to this level, you are telling the broker that please close the trade on profit for me at this point. I don't care, even if the market go up here. When the market just hits this level, close on profit for me. Entry points, take profits. When we talk about take profit, I want you to understand one thing. Price may not just all go to your way and eat your take profits most times. Sometimes price may even from here go down, come down, go up again, go up, come down, get here, come down, until you finally get to that level. But as soon as it gets to that level, that exact price, when price get to that exact amount, it will automatically close on profit for you. That is what we call take profits. Okay, take profit. So we are going to show you how to set your take profit when we get into mental trader 4 and mental trader 5 application. Now, understanding traders language, traders will always tell you TP. Okay, what's your TP? Now TP means take profits. Okay, TP, when you hear that word TP, it means take profits. Now we have take profit 1, sometimes take profit 2, take profit 3. Now you may ask yourself, what is TP1, TP2, TP3? It means there are 3 levels of take profit. So there are 3 levels where you can set take profit. Now the person telling you TP1, TP2, TP3 is simply telling you that I believe the market will get to TP1. I also believe the market will go up again to TP2 or go up again to TP3. Now, also note that take profit can also be used when you're also selling. So if you are selling, it means your take profit will be below your entry points. You know, the market, for you to be on profits, market must be going down. Okay, that is it. So TP1, TP2, TP3 on a set trade, the TP1 is done, the TP2 is down, the TP3 is down below. I hope you get the points. So take profit means, or TP means take profits. Let's dive into stop loss. Like we've seen, it is a security for your account to ensure that your account do not get blown up. Okay, so you can always put a stop order to your broker. So you see, this is where we enter the buy trade. Okay, yeah, this is a buy trade. The buy trade. If, for example, we are using here as our take profit, this black line as our take profit. Okay, we still need to also set our stop loss. You see this place now? This is our stop loss. So for take profit, we are saying that the price go up, go down, go up, go down, go up. When it gets to this level, stop on profit for us. But if while on the trade, the trade did not get up, came down, go, and if the trade finally get to this level, please, I believe that the market may not have the power to go up again. So please, broker, close this trade on profit on loss for me. Close this trade on loss for me. I hope you understand the definition of stop loss, my explanation of stop loss. So you are taking a buy trade. Now, remember, stop loss can be used whether you are taking a buy trade or taking a sell trade. Okay. Now, for a buy trade, this is a buy trade. Your stop loss will be below. Why? Because a buy trade will expect the market to go up, put us on profits. But a situation whereby the market is going down, we want to close on loss. Now, for a sell trade, if this is a sell trade, we took a sell here, it means down below will be your take profit. This will be take profit, not stop loss anymore. Take profit. Then up, somewhere around up here will be your what? Your stop loss. For a sell trade, your take profit will be below, your stop loss will be above. Okay? I'm going to talk more about this stop loss. I want us to understand this stop loss. Now, you see the level we put as stop loss? We are telling the broker that even if price is going down on a buy trade, please don't close the trade on loss. Don't close it. If price gets down to this level, don't close it on loss. It is only when price gets to that particular level, that price, that is when the trade will be closed on loss. Okay, so you see when you are taking a buy trade, you're expecting that here will be your take profit, this black line, the top of this black box. Markets may go down as it came down here, and then go up, and then begin to go up to eat or take profits. Yes, it happens. Market may go down, come up, come down, may not even touch your stop loss. It may get to the stop loss, but it may not even touch it sometimes and begin to reverse up. But if it touches the level, close on loss for me because I believe the market will go down from there.